be with you guys this morning. So maybe as we start, we can have maybe one or two people briefly tell us your expectations from this session. Kindly. Anyone? Anyone to tell us? So this is finance for HR. We want to basically make you guys get a feel of the finance bits, and we want to see how the finance professionals, that is the HR professionals, interact with the finance aspects in your organizations. So I would like to maybe get a feel of what you people expect from this session. I'm sure you all came in with one or two expectations. Thank you, Rolene. I see you want to have a better understanding of how to interpret the financial reports. Thank you so much. Anyone else? Boaz. Susan, Mombi, Pamela, any expectation from this webinar?
Yeah, actually, good morning. This is Pamela. Actually, my expectation is to understand how the finance aspect adds value to HR professionals, and how I can use the same knowledge just to be able to understand what finance team does and what we can do as HR professionals in terms of adding value to the understanding of the finance aspect. And in most cases, you find that the finance team or the accountants, sometimes they take it over from us in anything that has to touch on anything financial. And my expectation is from this forum, we'll be able to really understand what we should do as HR professionals based on our own with the support of finance. Thank you.
Thank you so much, Pamela.
Patrick, mine is just to understand the integration of the two, that is finance and HR, and understand the overlap and how, as HR professionals, we need to go about it, because these two entities, that is finance and HR, they're very crucial departments in the organization. So my main, actually, the reason why I'm here is just to know the integration of the two and understand the overlap.
Thank you. Thank you so much.
Okay, and for me, my name is Mombi. I'd like to be able to read financial statements, such that as a HR profession, most decisions that I make should affect the bottom line. So I'd like to see whatever decisions that I make in the office. How does it affect the bottom line? And then again, it will also help me in making decisions that improve the bottom line, and not just talking about feelings. It really needs to be proven by figures and trends. Thank you.
Okay, thank you so much. Anyone else? Yeah, so basically, thank you so much, guys, for your inputs. And I see the main concerns from the attendees today is about the integration or the overlap of the HR function and the finance function in our institutions. I also see the need to be able to understand and interpret some of the main financial statements that we develop at the corporate level. And of course, you guys as the HR decision makers want to see how your the decisions you make in your departments or in your directorates or in your HR sections, how they affect the overall financial status of the institution. So that is very important, and that is basically the understanding behind this course. So I think we will be able to. I think we'll be able to meet your expectations. So unless maybe anyone has some other burning concern that you don't address, maybe we can get into the presentation and yeah, see how it turns up. So, okay. I will now share some the presentation. So, is it visible? Hello, is it visible?
No.
No, we can only see some folders.
Oh, it's not visible.
No, we are in
We only
your
see folders, huh?
Okay.
in your folders,
Okay.
where we can see there's some files.
Okay. How about now? Yes, then. Hello. Yeah.
Oh, you think the ada ana meeting moro ka ma yi
Hello.
Yes, Patrick, we can
You
see
can.
some. Yes,
Oh, you can.
financial picture.
Oh, you can see it now.
Yes.
So we can start.
Yes.
Okay. So thank you. Sorry for the small hitch. So these are some of the objectives that we wanted us to go through in this session. And the first one is the 5 critical elements of business acumen. So this is basically what you guys have told me from the expectations. This is about understanding the financial aspect of our organizations and our companies. So the second objective is, an understanding of the importance of business acumen to the HR professionals, so the HR business leaders, which is basically the people who are here today. We'll also see why we need to understand finance. And under these, we'll also cover what some of you are asking about, the understanding of the financial statements that we commonly use as the finance guys. Of course, there's the issue of the benefits of this financial knowledge to you as the HR people. We will also be asking ourselves a very interesting question. Is finance an art or a science? I think you guys will be able to tell me that as we go on. There are issues of expenditure in our companies. And here it will be interesting to see that you guys actually bring up most of the expenditure in our institutions. That is staff-based expenditure as the HR managers. We'll also have a deeper feel into some of the assumptions that we make when preparing some of the financial institutions and when making some of our financial decisions. And maybe understand the implications of these assumptions to the HR aspect of the firm. Now, this is just, of course, general objectives. I'm sure as we go on, as any concerns come up, we will be able to address it as part of the session. That's okay. Yeah. So I would want us to get right into it and look at what we call business acumen or financial acumen. So basically, this is the ability of people to understand the financial impacts of our actions, our judgments, and the decisions that we make on a day-to-day basis. So in this context, we want to see how we want to understand the financial impact of the decisions that we make as the HR professionals. You guys make a lot of daily decisions, especially decisions regarding the staffing levels, decisions regarding the operations at our places of work. You guys decide whether to increase the number of staff, whether to reduce the number of staff. You guys are key in some of these decisions, and we want to understand what's the impact that these decisions that you make, as you make that proposal, maybe to the finance manager or to the CEO, as you send in that training request for your staff, what's the impact of that on the financial health, on the overall financial health of the institution? So that's what we call the business or the financial acumen. So it's basically the awareness. It's basically the awareness of your decisions to the overall financial health of the company that you work in or the business that you run. We could also include the aspect of understanding the basic financial and accounting principles. And by so doing, again, as you make your daily operational decisions, you will be able to see the impact of your decisions on the financial on the financial books at the end of the period. So in a nutshell, that's what we mean by the financial acumen. Allow me to move on to the next slide. So now, what are the key elements of this thing that we are calling financial acumen? All right. So these are basically the 5 key considerations that we need to make when doing our HR operational business in the company. 1, financial acumen involves strategic thinking, or what we call strategic planning. Now, strategic planning is very critical in the corporate world. Strategic planning involves something that we call a SWOT analysis. I'm sure you guys have heard of a SWOT analysis. So this is basically an analysis of the institution's strengths, the institution's weaknesses, the opportunities that are up for grabs, and the threats that face the company. So as HR professionals and as finance professionals, it is ideally very critical for us to think strategically. It is up to us, when we're in those boardrooms, to be able to make decisions that are centered around, the strategic growth, strategic direction of the firm. So we cannot do this if we do not have that financial acumen. We cannot do this if we do not really understand the impact of our decisions or the impact of the plans that we make on the overall growth or on the overall financial health of the institution. So that's why we are saying one of the key elements of our financial acumen that we need to all, cultivate is strategic planning. The second key acumen is financial literacy, and it's interesting to see that most of you will want to understand some of the financial statements. Now, this is also important since the interpretation of financial statements will always form the basis of, also form the basis of the decisions that we make. We are all leaders in our own ways. We are HR leaders. And in our institutions, you guys are the people who interact with the staff more than anyone else, more than the other managers, more than the other directors. So you are also likely to be faced with situations where you have to maybe explain even to your staff some of the financial status of the company. I will come to you as my HR boss and tell you, I would want to get a promotion. I want a pay rise. I would want to go for some training somewhere. And as you try to softly tell me no, you could throw in some of these interpretations of the financial status of the firm. You could easily tell me that currently the firm is not doing so well financially, and through the financial literacy that you'll have gained over time, it will be more impactful when you can even delve a little bit into into some of these interpretations, issues of budget allocations, issues of resource management, and all these. So we also want to develop our financial acumen as HR professionals. We want to know what really affects the business performance of the company. As much as we understand what affects the staffing performance, we also want to understand the business side of the company. We want to understand some of these financial statements. We want to understand some of these financial ratios that the accountants are using. We want to understand the budget process. We want to even understand, the issues of resource mobilization, issues of resource management, issues of, that interaction with the donors. What's the importance of these donors, so that when we see them come to visit our companies, we understand the impact that these guys are possibly bringing to the farm. The third key element of business acumen is customer focus. Now, more often than not, especially in the big institutions, we have that demarcation in roles. And we find that we are probably leaving the customer focus aspect to the customer care sections or the customer care departments. But with the background understanding of the importance of this customer, we all understand, of course, customer is king. And how is customer king? Customer is king because they sustain the business aspect. All these things we're talking about, the statements, the sales, the revenues, the profits, all these is because we have customers whose needs we are expected to meet. So as a HR professional, what do I do when a customer comes to my desk? Maybe they are lost. They wanted to go to the customer care desk, but they end up at my HR desk, right? So we need to appreciate the customer's needs. We need to to understand, even if it's for a little bit, we need to understand the trends, the customer trends. We need to be able to understand the customer behaviors, and by so doing, we will also be able to to help the people responsible for customer service to meet the customer's needs. So financial acumen expects us to understand customer focus, expects us to be able to create, when called upon, to create strategies that will always be beneficial to the customers. The fourth element is an entrepreneur's mindset. We all know who an entrepreneur is, to be able to, for someone with a good financial acumen, you're supposed to be able to easily identify new opportunities. You're able to you should be in a position to create new products, and you should also be able to make decisions or strategies that will help you venture into new untapped markets. So now these again may look like somebody else's problem from a HR manager's point of view, but we have all agreed that there is a lot of overlap, especially at the top level. There's a lot of overlap between these functions. We are all working towards a common goal: sustainability, profitability of our organizations. We want growth for our organization. As a HR person, I want growth, maybe mainly through the staffing. The finance person will want growth through the financial aspect of it. The CEO will oversee the whole growth. But there's a lot of overlap. When you guys sit in those boardrooms, you cannot just be quiet and wait for the HR bits for you to make your contributions. So we want to create all-rounded professionals who will be able to chip in strategically, who will be able to propose strategies that will even propel the institution to higher heights. We want to bring in innovation. Probably for those of us in finance, probably we've somehow exhausted our ideas, and the HR professional might see things from a different perspective. Yeah, so the fact that we are all expected to have that entrepreneur's mindset as we sit in our offices is why we are having why we have these elements as one of the key items under financial acumen. And last but not least is leadership skills. This is key. You guys are basically leaders. You lead staff. You lead us in our places of work. You should be able to inspire our confidence. You should be able to motivate us daily as we work. You should be able to, to communicate to us. You should be able to empower us. We have our KPIs, we have our set goals, we have our set targets. You should be able to, to motivate us so that as I wake up every morning and come to work, I am able to, to get that strength to keep going. I should not just be motivated by the payroll or by my payslip. All right? As decisions are made in the boardroom, it is you guys who should be able to easily interpret some of these strategies that the company has to the ordinary staff at the lower levels. So these ability to lead your people, not lord over them. The ability to lead your people and inspire them is what will bring in the whole, the whole financial growth of the company. Tuko pamoja? Are we guys together, or I'm alone here?
Yes, we are together.
Yeah. Very well. And you guys feel free to, if you need any clarification or interjection, you can feel free. Let's have this session being a little more interactive. Thank you. So allow me to move on to this. I want us to ask ourselves, or I want to ask you guys as the HR professionals, do you think you need to understand finance? Okay, of course, some of you already said, when you were starting, but I am sure I see there are many new guys who have joined us. Welcome all. We want to ask ourselves, as HR professionals, do we really need to understand finance, or we need to focus on our HR roles?
Yes, we do need to understand finance. And
Yes.
I guess you really answered the question with the previous slide.
Yes.
And then again, I like the last bit of leadership skills. Also not just from a HR perspective.
Yes.
First of just having targets. You need to, and just being told we need to make money. But then I need to understand, let's say, how did we arrive at this target? Just not just a number. Yes, so the target should be what it says, achievable and all, realistic and all those things much. But then, of course, we work with finance so that we understand, so that this number is not just not from the sky. We just don't say because we did so much last year, so now we increase by 20%. There must be a reason why we're increasing. There must be a reason why we are increasing 20%. And then the other thing is that for me as HR, to make even my team understand, we need to do these bits because yes, we need to achieve certain results. And then the other thing is that when companies are not doing well, the first people to be touched are staff.
Sure.
So then I also need to, at the boardroom, I need to stand on my ground. And when I understand, let's say when I understand the financial statements, then I'll be able to stand my ground and just say, no, we are not touching staff because of A, B, C, D. So I'm not just getting emotional, or I really want to move away from from feelings, this thing of saying so and so is good, so and so is what, but it's just to say, when I look at the financial statement, I'll be able to say, this is not our biggest cost. Maybe something else is our biggest cost, or it is our biggest cost because of ABCD. If you touch stuff, this is the impact. Such that when you're making a decision whether to lay off staff, it really is the best. It's the best decision, not the first and only decision, and sometimes our only decision.
Thank you so much, Mumbi. I think you've actually almost preempted my next slide. Thank you so much. So we can all agree that we all need to understand the financial aspect, yeah? Unless someone has a contrary opinion, I think we should be able to, we are good to go, yeah? So this is it. We've agreed that we all need to understand the financial aspect as HR professionals, yeah? Now, these are some of the key reasons, or why some of the key points why we all need to understand the financial aspects or the financial health of the institution. Number one, you guys are always at the forefront when the company is doing the recruitment, when the company is proposing structural changes, increase of staff, reduction of staff. This falls squarely on you people. Now, the key factor or the key consideration in hiring, of course, is the financial status. As you propose to, maybe introduce a new section or increase the number of staff or bring in new professionals into the organization, you will bring that proposal to the finance people or to the CEO, depending on the institution. And the key consideration of whether this goes through or not is basically the company financial performance. I think this is almost straightforward, because we find that as the company grows, or as the company does well, makes profits for the owners, there is that growth, there is that expansion. And that expansion brings in hiring. So ideally, we will not have a lot of the hiring aspects unless we have a lot of financial growth. These two are directly proportional. These two go hand in hand. And I think this is one of the first point and the second point. The second point is about staff turnover. Staff turnover, of course, you guys really understand some of these terms. Staff turnover, the exit of staff, the coming in and exit. How does the institution retain staff? How expensive are some of these things? Staff turnover. I know it's a huge financial expense, but maybe someone can break it down for us kidogo. I'm sure you guys have a better understanding. How is staff turnover a big financial expense? Or do you think staff turnover is expensive to the firm? Anyone briefly?
Yes, it is.
Yes, please.
Yes, it is. I can maybe say staff turnover translates to HR.
Yes.
In the sense that you have to hire people, and hiring people means also time, because you've got to set a panel or you've got to pay a recruiter. And there's also the aspect of training. Before this staff turns into understanding the concept of the company and starting to be productive, there is that waiting time. Yes. So during that time, you are paying, and sometimes after that, maybe that's not a good fit. Maybe he's good for another industry, but not that one. So he equally leaves. Maybe the company is also terrible. I mean, it may not be the person. So we may not say the person, and maybe the person may not just fit in with the culture of that organization. So a company that already has a record of high staff turnover makes it attracts staff who are also not producers.
Yes.
You see, because other people who are looking for jobs these days need to read the ratio of staff turnover.
Sure.
If they see it's high, then it's not an attractive company. You are likely to be fired. So it's like you get in and you ask, what are the firing reasons here? Then you're told, if you don't smile at the tea girl, if you don't do, those kind of things are politically instigated, but they tend to bring a certain cost factor. Yeah.
Yes. Thank you so much. You see how the HR aspects have a direct impact on the financial situation of the family. The moment a staff comes in and then leaves after 3 months, after you have spent on the training, after you've spent on all those maybe benefits, after you've spent on the recruiting panels, the evaluation panels, the interviewing panels, you've paid for venues to do recruitment. And then 3-4 months down the line, you still have to repeat the process. Now that is staff turnover and its impact on our finances. So I think we can see the overlap and the integration of okay, staff turnover is of course it's not a HR course or a HR decision, but I think as the HR professionals we are more invoked in making or proposing to the top management strategies to help us retain staff more. And that comes into that point. We want to retain staff. We want to attract and retain the staff. Retaining the staff means that we reduce the costs we have seen in step number two, the costs associated with the staff turnover and staff in the hiring process. So as we propose to change our HR manuals, our policies, or as we propose to remove that requirement of smiling at the tea girl, like our good friend has told us, we want to also have that balance. How do you attract and retain staff as HR professionals? Now, apart from, of course, paying them more. Someone tell us briefly, how do we, what's the best approach of attracting and retaining staff? Maybe in a statement or two, anyone?
Okay, let me take this.
Yes, Rachel.
I'm on the road, so yeah.
No
So what the best way of attract customers is the image of the company. What image do you have in the organization? Yeah. What are your skills? How do you compare yourself to the other companies in the industry? That's the beacon of attraction. Yeah. Because all staff who come in want to compare how you're doing with the others in the same industry. On the section one, it begins with the onboarding of staff. Do they understand the role? Do they understand the organization, the culture, So how do we onboard our new staff? It really makes a big part of the employee retention. So once they understand the culture, the system and all that, they'll be able to acclimatize very well and settle in very well in the office. And secondly, are the staff, the issue of the perks on motivation, How are the perks? Are they well trained? Yeah. How do you take them their presence? Are they objective? And do we communicate growth to the staff? No? Are they seeing progression to the next levels? Yeah. Is there fairness in the HR issues like salaries and allowances and all that? So yeah. Above all, staff want to see them being commended for the good work they're doing. Yeah. Okay. So there's so much that surrounds employee retention. Yeah. Which HR need to have in their policies communicate to managers for them to be able to do this. Yeah, thanks.
Thank you, Rachel. So Rachel is a good HR professional, as you can see. She's more interested in making these new staff feel at home, helping them meet the soft expectations that you have. That is very fine, and that is very, very commendable from a HR perspective. But we also agree that doing all that to make these new staff comfortable is also expensive. There is the financial implication. You will have to pay this staff to attract a staff. Let's use a local example. To get a professional HR staff from Safaricom and bring them to Airtel. You're the HR manager at Airtel. You want to attract this staff from Safaricom. You will have to pay more. You need this staff. You'll have to pay more for their skills. You'll have to pay more for their services. Now, how do we balance? How do we achieve this balance? We want to retain this staff. We want to attract them and retain them. We want them to be comfortable at their place of work. But then again, this finance manager is telling you that we cannot afford this staff that you want to attract. And you're telling them, this is the person that we need for this job. They have done interviews, they have told you their salary expectation. So now you're having that discussion as you analyze the marks. You're saying, this guy is the best person for the job, but they want X amount of money. The finance person is telling you, that's okay, but we have Y budget for this new staff. So how do we strike this balance? You see, if you're a rigid HR professional who is probably not interested in the financial aspects of the firm, you will want to insist that you need the company to bring in this person for you. And I think that's why some of these information is important. Some of this understanding is important, because we want to be able to understand. Yes, I will bring in this person, but how much impact will it have on the finances? You'll be able to tell yourself that, okay, as much as you want this new guy who is very skilled, it is probably cheaper to get this other guy and maybe train them, or it's even cheaper to try and retain or try and train the guys that we have, instead of trying to poach a new guy when the company is not doing well. Yeah. So we are saying that as we make our HR requests, as we make these requests for staff, as we want to get the best from the market, or the best in the market, we also need to consider the financial situation of our institution. And by so doing,
Sorry.
Yes, Mom.
I just, sorry to interject, I had a different line of thought.
That's okay.
Yes, I was thinking, if I wanted an expensive staff and this person is really good, let's say there's a wide gap between number one and number two. You see, if I understand the financial statements and the ratios, etc., I can still insist, because then I'll look at the financial statement and see where else maybe we can get money from to top up. You see, to top up salaries. But you see, once I don't understand that, then I would suggest let's move money from here, some money from here, and some money from here, and pay this person, or even just to customize. Let's say customize the expectations we have for this person. I can also, once I do that, I can also mention to the person and say, within 6 months, we expect you to do ABCD, because most probably it's a job you've done in Safaricom, you're coming to do it in Airtel. So the only thing is that it's just that maybe a few things like company culture that will change. But we give you a timeline. We tell you within 30 days, this is what outcomes we expect. Within 60 days, these are the outcomes we expect. So that I'm able to share with finance. Because if I agree with finance everywhere, most companies we will never have enough money.
Yes.
There's not. It is very rare to have enough money. So as HR, I need to be creative. And yes, and make such suggestions. So I can only make them if I understand the financial, if I'm financially literate. Thank you.
Thank you so much, Munde.
May I add something?
Yes, Alice.
Yeah, thank you. I feel at this point I can give an example of what happened recently in an organization I'm familiar with. During the recruitment, the best candidate, a very good candidate, in fact, a trainer for HR, we needed, the organization needed an HR person for a long time. There's nobody who can set up performance standards in systems. So in the interview, there's this very outstanding candidate. But when it comes to salary expectation, it is higher than that of the CEO. So what does the panel do in the end? Of course, they took the second best. They said the second best was a young, very knowledgeable, very many qualifications, paper qualifications, young, and they said this one can grow in the organization and the salaries are affordable. Exactly 5 months later, that young person got an offer with a board, a parastatal body, and they quit. And here the organization, oh, we got somebody, now we can set up systems. So it really happens in real life. What do you do when the salary is far above what you can offer? You need those skills. You take the cheaper one because you will grow them younger, cheaper. But the younger, cheaper is ambitious. They get a better offer. They live 5 months. Now they are on the border again, is thinking of advertising. So I just wanted to share that experience. It happens in real life. What do we do? Thank you.
Thank you so much, Alice.
I think I want to add something. I want to add on something there.
Yes, Richard.
That again, as HR, we should go beyond looking at money as the only motivator.
Yes.
Yeah. I know when they drive towards money and high pay. But you'll find that most people, you can have all the money, but there's no work-life balance.
Sure.
You find the environment is unbearable. It's so toxic. The culture is not so welcoming to you as a staff. So I think even as HR, even during recruitment, we should be alive the fact that there are other issues you can look at, which are non-monetary, to attract staff who are coming to join the organization. And that's why the image that the company has, how it's portrayed by the outside people, is very, very important during a recruitment of staff. Yeah.
Thank you so much. Anyone else wants to chip in? Jen? Yeah, this is very interesting. You know, as I prepared for this, I was not so sure, but it's now coming out so clearly that you guys face these challenges almost on a daily basis. This is very interesting. So we've all agreed we need to ask ourselves, how do you balance between the financial, the financial attributes of the firm and the fact that you want to bring in and retain the best staff for the institution? I think that is that's a challenge that as HR professionals you deal with almost on a day-to-day basis. But of course, I'm sure as you get to appreciate and understand the financial view of the company, you'll be able to even make better decisions. You'll be able to make better balances. in your decision making. So the
Excuse me.
fourth, yes, please.
Yeah, I just wanted to interject on something. Yeah.
Yes.
Like personally, I believe finance department need to always have a chair, a seat in the meetings of the strategic meetings of HR.
Yeah.
Because if you allow them to choose, they'll always pick the cheapest person, because you see the aspect of the objective of finance is to reduce costs. So reduce costs. And so because of that, they'll always tend to back. And you know, finance, truth be told, within the African scene, finance would have a larger stake in the say where the board is concerned, because the nature of finance is data oriented. Yeah, you are data oriented, you are data driven. So if we have to use data analytics, we will never bring the soft part of HR. And the soft part of HR is the one that will either turn the turnover, the revenue, or not. So the aspect is this, and I'm giving a situation like my sister just gave. Marketers, marketing department and finance department is like oil and water. Okay, because marketers are spenders.
Yes.
And finance, they are, sometimes you think they normally say that finance people, one of the units that they study is being mean, you know. So because of that, marketers always clutch, because they are bringing in the money.
Yes.
They are making the company awareness, brand management out there, so that people will buy our products and the revenue will move up and pay those high salaries. But now, if you don't see that aspect as the finance office, you will go for a cheaper model that works within the objective of finance. And so we end up losing very key staff. And there are critical organizations that the MD may actually earn less than a marketer. You see, a marketer who comes in, I was involved in the hiring of one. And he just said, these are his terms. And for the first time, I saw someone asking for financial statements and said, in your revenue, I will double, triple this revenue by this particular time. So if I do that, what are my stakes here? And so they said, okay, what do you want? This is the percentage of commission that I want. For beyond this particular target, this is what I want. And they thought, people say that and they don't do much. You see, finance people would always bring the devil. They are the devil's advocate normally in a meeting. And so they'll always come up and say no, or yes. They didn't think it was, the guy would reach that. And in 2 months, the guy actually turned the tables around. And all the government contracts came. You know, they came, you don't know how, people are gifted. And now it was time to pay him the money and the commission. The head of finance woke up at 6 a.m. to the CEO's office. And, oh, you know, this one is like this, is like, we can't, because we need to take care of this problem. Now that problem was there before this guy came. So why are you all of a sudden changing? And probably this is the aspect that we need to consider when it comes to HR. Direct involvement with finance is required, so that they see the soft side, the soft aspect. The soft works of HR are the hardest, because they are probably not driven by data analytics. I just wanted to interject on that, because it's a real situation on the ground.
Thank you, Catherine. You see, you guys are even bringing it out even more clearly, maybe probably than I would, because you're the people on the ground. So the integration and the overlap between HR and finance is deeper than we see it. You know, it's deeper than we see it. As Catherine has told us, the HR, the finance manager will always be reluctant, you know, maybe to spend more on staff, to spend more on a staff. But as the HR professional, using also your soft skills, you are in a position to, to identify and convince the organization that this is really the person that you need for the firm. So as we went, back in school, as we went through that course of meanness, like Catherine said, we were always told to to focus on the end goal, and the end goal is developing value for the owner of the business, whether it's a private business or whether it's a public one for the shareholders. And I think along the way came HR, with different perspectives. And of course, we've been trying to, to readjust. We've been trying to be more accommodative. And yeah, I think like we can see, like in the 5th point here, staff-related costs take up a bulk of the total revenue. It's actually one of the main cost items in most of our financial statements, especially in the public sector. We all know that staff costs or personnel costs take up even up to 70% or even more for some institutions of the overall revenue. You make 100 million as a company, and 70 million goes to paying for staff. Si mnajua hivyo. So I think that the problem is real. The problem is real from your end as the HR professional, because you want to satisfy this staff, you want to bring in the best staff. And it's also real from my perspective as the finance manager, because I cannot continue paying for, taking up 70%. Your costs are taking up 70% of my revenue. So how do we operate? How do we get to a middle ground where our costs are now manageable, where I'll be able to retain some of the revenues, to pay the suppliers, where I'll be able to retain some revenues, to pay for development projects, or to pay for other expenses, the operational expenses, or to pay loans, and still make money for the owner of the business, or the owner of the shareholders. Yeah. So I think the challenge here is real. We need to sit together more often than not. Yeah, I think the finance guys need to be more invited to be invited more to your HR conferences and seminars. Yeah, and do the same to the other end. ISPAC needs to invite more HR professionals, to attend their seminars, because this is it's a real issue. Yeah, we can see from the 5th point, staff costs take up a huge percentage of the total revenue. In Q1 of this financial year that is coming to an end, the county governments spent, this is almost 80% of their total revenues on staff costs. 80%. That means only 20% is left for development projects, is left for paying services, paying bills, paying suppliers and all that. Of course, I understand there's the issue of maybe misappropriation, yeah? But it's true that most institutions have staff-related costs as one of the key cost items. So I think this is a good forum to for us to.
Allow me interject on that.
Yes.
Just like the good lady said earlier.
Yes.
You see, the issue with you finance guys, you see human resources as a cost.
Yes.
That is the biggest problem. You see, even you are saying that in the county office, they spend 70% on human resource, which to finance is like absurd, But the day we look at the HR as an asset and reward them well, that's the day you will enhance your productivity and increase your company revenue.
Yes.
So we need to look at the HR as an asset. Yeah. So as much as you work on your P&L account, yeah, where is HR? So when the staff are motivated, are well rewarded, yeah, you'll have more income to the farm. So we need to divert this thing and look at the HR as the company on HR. That's why we lose it. Let's look at HR as an asset and a revenue. That's now how we'll grow the next levels. Yeah.
Thank you so much, Rachel. And that brings me to my next point. How do we treat HR as an asset? HR is clearly an asset. Actually, from the basics of business, HR or staff, or call them personnel, they are one of the key factors of production. You cannot do anything, you cannot do any business without the people doing it. So they are an asset. It's only that, of course, in the guidelines, the accounting principles and guidelines, we cannot have them categorized under assets, because assets are items that are supposed to bring us money, and we do not bring in stuff to bring us money. We cannot treat them like assets per se. But we can all agree, and I think we all agree, me, myself included, that HR are a very key part of the institution. So now, having said that, we are not, of course, interested in reducing the some of the staff related costs, like salaries. That is not the interest. But how do we reduce the percentage? Like in this example, how do we reduce the 80%? The best approach to reducing the 80% is by increasing the revenue, the total revenue. We don't want to bring it to 50% by cutting salaries, cutting allowances, and all that. We want to increase the revenue so that this ratio goes down. And that lies again on your desk. We want you guys to come up with the best strategy. We want you guys to motivate this staff. We want you guys to lead the HR aspect, to lead the staff towards achieving the strategic goals of the organization. And by so doing, we are able to, at the end of the day, increase the total revenue. So if, like in this example, if our revenue was 100 million last year and our staff costs were 80 million, so how about we try and increase our total revenue through this staff? How about we lead them? How about we come up with better HR strategy? How about we motivate our staff? How about we develop favorable policies that will make all of us enjoy working for this institution? How about we come up with policies that will be able to attract the best staff, like we've said? Yeah. How about we try and make this company a good place to work in? We develop the working environment so that we are able to attract the best staff. And when these staff come in, they'll be able to increase the value of this company. And by increasing the value of this company, we'll be able to increase our revenues. So this year, we will be able to grow our revenues maybe to 200. If we grow our revenues to 200, our staff costs will have gone, the ratio or the percentage of the staff costs take up out of the total revenue will have gone down without us touching on the staff benefits. Does that make sense from a HR viewpoint? Iko sawa hivyo?
Yes, makes some sense now.
Yeah.
Yeah, makes some sense. When it comes to cost cutting, they just
Mhm.
they just focus on the people only. Yeah. Look at the
Yes.
other aspect of the business that may require cost cutting. Empower
Mhm.
your staff to bring in more revenue
Mhm.
to the organization. That is the
Yes.
bottom line.
Mm.
Yeah.
Yeah. So to me, the best approach to, reducing, okay, for the finance guys, we'll talk of figures. We'll say 80% as staff costs, and we'll call it a crisis meeting, which is okay. But the best approach to this, and of course, we expect you guys as the HR professionals to chip in here and say, no, we are not touching on the staff costs, we are not downsizing, we are not doing all that, but we are committing to improve productivity. Now that's your responsibility. Yeah? You want to be empowered so that you can empower the staff to increase productivity, and by increasing productivity, we will increase the total revenues for the firm. And in the next financial year, utapata the percentage goes down to even 50%, and the staff is happy, the owners are happy, the bosses are happy, and everyone is happy. Yeah, so that's an ideal, overlap. That's an ideal integration of how your HR policies, how your expertise will be able to cater for the growth of the company, and keep the staff satisfied. That's a proper way of creating that balance. Yeah, I think we can go on from there unless anyone has an issue or a comment or a compliment or a interjection. Good. Yeah, so number 6, we're saying that staff performance is directly proportional to the company's performance. That is not debatable. As I said, the staff are one of the key factors of production. If the staff that you have are performing, then the company is performing. If the staff are dissatisfied and are not performing, you're always on the streets, haki yetu, dissatisfaction, then of course that company will not perform. But if the staff are happy, well motivated, well remunerated, then the company grows, the company performs well. Now, we have an interesting question here. Is finance, do you think finance is an art or a science? Do you think finance is an art or a science? You want to give it a try?
Please define an art and a science first.
You're saying it's both.
How do you define a science in a layman's language? How do you define an art? Back to you.
I will define, okay, in layman's terms, I will define science in terms of the use of theories, principles, all that, and define an art from the perspective of the human emotion, the human approach of it, the social aspect of it. Just briefly.
Then I'll say it's both. It's both a science and art because, of course, finance has many theories, the principles that we learned in the basic accounting, prudence, all that.
Yeah.
But again, because it involves people who execute the principles, that now makes an art. So I'd say it's made that.
That's true. Thank you for your perspective. I think I think the right answer is both. We can say that finance is both a science and an art. And as the lady has correctly told us, finance is a science because there's that use of those financial theories which are based on statistics, mathematical formula, and all that. But also, most importantly, it is an art, due to the behavioral aspect of it. We are saying that finance includes behavioral relationship of individuals with money. Yeah. The interaction of emotions, or the how money or the finances elicit the human emotions. And we all know what happens when you guys keep telling us to be careful when making decisions. Saa zile tuko na pesa. Yeah, and you can attest that some of us don't make very good decisions during the end of the month. Mnatulipa leo alafu we don't show up for 1 or 2 days in some places. So that is the impact that money has. That is the impact that money has on the behavioral relationship. So generally, we can say that finance is both an art and a science due to the inclusion of both of those perspectives. So I would want us to to delve into something here, the financial statements, and we'll not go into very deep ones, but we'll be able to have an understanding of the basic or the key financial statements in for a company. And some of these statements, we'll start with the basic one, which we call a balance sheet. I'm sure you all know a balance sheet. We'll also look at the income statement, or the P&L, that is the profit and loss account. We'll also see what we call a cash flow statement. Na ingine inaitwa changes in owner's capital or owner's equity statement. I hope that is not where it gets boring. Yeah, ndio easy. You have the income statement, you have the balance sheet, you have the cash flow statement, and what you call a statement of equity. So let's look at the first one, which is a balance sheet. I'm sure even in school, you guys of course learned some of the basic accounting, and a balance sheet is the basic financial statement. And a balance sheet basically shows the company's assets, liabilities, and capital. So capital is what you call the shareholders' equity. Yeah. And the only important thing in a balance sheet is knowing the relationship between the assets, the liabilities, and capital. Kwanza, we can do a broad definition. No, that's the formula. The total of the assets should be equal to the total of the liabilities plus the capital. Assets ni nini? Apart from HR, apart from the staff, someone told us the staff, we should treat the staff as assets. So assets are basically the items that have economic benefit to a company. Items. I think that's why we don't classify our staff as assets, because they're not really items. So these assets include things like the buildings, the land that the farm has, the furniture in our offices, computers, the cash that we have in the bank, the cash in the cash boxes, something we call the debtors. These are people who owe the company money. Yeah, all these are the assets, basic assets of a company. Liabilities ni madeni. These are the what the company owes other people. Basic example, the loans that that the company has, and the creditors, apart now from maybe the bank loans, there are other people that we owe money, like maybe the suppliers we've not paid, or even the bills that we've not paid. Now, there's also something known as equity or capital. So capital is basically what the owner of the business, the money that they put into the institution. So normally we treat the business owner and the business as two different entities. Yeah. So if I own this company XYZ, if I own this company and I put in 1 million shillings to start the company, that is what you're calling capital. And that money remains, that money is not an asset to the company. I can say that the company owes me the 1 million bob. That's why if I need to sell this company, I will be given back the money, of course, with the current valuation, but I will have to get something in return because I invested into it. Now that's a case when we have someone who owning the company. There's also the case of the public institutions where we have shareholders. You buy shares into Safaricom, you have a part owner of Safaricom, and Safaricom owes you money because that's the amount you put into it. That's what you're calling equity. So equity or capital is what the business owes its owners or its shareholders. And that's why if we go back to the second point, we are putting these things on two ends. There is what the company owns, which is what you're calling the assets. These are owned by the company. And then on the other hand, kuna madeni za kampuni. That is the liabilities, the loan, those loans and all, and the money that the company owes either the shareholders or the business owner. And that is what makes up a balance sheet. It should be a balance between what the company has and what the company owes other people. Are we clear on that?
Yes, we are.
Inaeleweka?
Kabisa.
Thank you so much. Maybe we can just look at a basic balance sheet. We'll try to share something here. Can we see this?
Yes, yes, sir.
Oh, you can see the Excel.
Yes.
Okay. So these are basic example of a balance sheet for this company that you're calling XYZ for the year ended December last year. So basically, this is how it looks. Yeah. This is how it looks, and it will be more complicated or more simplified based on the company, based on the size of the company and all. For this, just for illustration purposes. Yeah. So we start by listing the assets. Of course, not all the assets, but we categorize, we clump the assets together. Then we get the total of the assets. We look at the liabilities. You have a total of the liabilities. We look at the shareholders' equity or capital and get a total. And you should always balance. Yeah. So the total of the assets, in this case, we have 1.2 million, should always balance with the total of the liabilities and the shareholders' equity. So from these, we can see the assets are classified into two general classes, that is the current assets and the long-term assets. So basically, the difference is in terms of how quick you can liquidate your assets. How quick can your assets turn into cash? Okay. Of course, the most current asset is cash. Yeah. Cash, either cash in hand or cash at bank. Yeah. You can just go to the ATM or over the counter and get cash, and the company does a transaction or pays for something. You can use the cash in the till to do the transactions. So cash is the most liquid asset. The second one is something we call the debtors. So debtors are basically people who owe the business money. Those are the debtors. And they are current assets because they're not long term. Yeah? You can follow up and get the debt. Maybe you've sold your goods, or you've sold your stock to someone, na bado hajalipa. So that's not a long-term asset. It's something that you expect that they would pay basically within the accounting period, or basically within the financial year. Yeah, I don't think there's a business that that wants to sell or to have debtors go beyond 1 year. I think we all want to, when you make a sale, you want to get the money as soon as possible. Yeah? So that's why we're saying the debtors are a current asset. We don't expect it to go beyond a year before we receive the cash for it. The third one is stock or inventory. So this is basically if your institution sells things, this is the stock that you have. So this is stock that you can easily convert to cash. That's why you're also saying it's a current asset. You can easily sell it and make money out of it. And next example is the prepaid expenses. Prepaid expenses are basically the bills that you have paid in advance. Like you might have paid the rent for the offices in advance. You might have paid the electricity bills in advance. Yeah. So that's an asset for you, or that's an asset to the firm. Okay. So there's also the next class of long-term assets. So long-term assets are basically assets which, in case we want to get cash out of it, we do not expect to make quick cash out of it. Like if the company has land, and this is probably land that the offices sit in, or the buildings that the offices are where the offices are located, that's an asset to the company. But it's an asset, but you cannot easily, you cannot say now that you are broke, let's get money out of this land. You cannot do a quick sale. Let's see if you can get money by next week out of the machinery that you have. Let's get cash out of this building by next week. So you cannot easily liquidate the long-term assets. And that's the main difference between the current assets and the long-term assets. Now we have assets that are intangibles. Yeah. Things like patents, things like licenses that you own, things like trademarks that you own. All these are assets. It's only that they are intangible. Not like the computers that you guys are using, or the furniture, or the desks and all. These are also assets, but they are intangible. So you also classify them as under assets. Yeah, so we get the total of the assets, then go to the liabilities, prepare a listing of our liabilities. Again, we have current liabilities, we have long-term liabilities. Same logic. The current liabilities, we are expected to pay them off at least within a year. Yeah. So these are an example is the short-term loans. We can have a 6-month loan or a 1-year loan. We have things like accounts payable. Accounts payable are basically the creditors. These are the people that we owe money. Maybe someone has made supplies to the company, and the finance guys are working on the payment. So of course they expected even legally to make payments within I think 30 days or 90 days. I think 90 days for most public institutions. So that's a short-term liability. That's a current liability. We have things like accrued expenses. Maybe the company has not paid its rent for 2 or 3 months. That's a liability, but it's also a current or a short term, because we expect that you will not default on the rent for more than 1 year. Of course, if you do that, you are probably going to be evicted. But maybe you've defaulted for a month or 2. That's an accrued expense. So some of the long-term liabilities, of course, include the long-term loans. Can have a 5-year, 10-year loan from the bank. We have bonds that are supposed to be paid to the investors, like the government issues the infrastructure bonds, the treasury bonds. Most of these are 10-year bonds, 15-year bonds that they are payable to the investors. So these are liabilities, but they are long-term. And long-term liabilities are good for the institution, because for the finance guys, we're able to plan longer for them. We're able to plan longer for their repayment. You are akishwi sana to pay them, because you have like 10 years to make the payment. So then you get the total liabilities, of course, from the short term, from the current liabilities and long-term liabilities. We get the total liabilities, and then add these to the shareholders' equity. So basically, the shareholders' equity, we said there is the money that the owner has put into the business, or the shares that the shareholders have purchased. That is shareholders' equity. It is part of the liabilities. And what we call the retained earnings. These are things like the dividends. Yeah, dividends that you're also supposed to pay the shareholders. All these now added to the liabilities are supposed to balance with the total assets and make what you call the balance sheet. Yeah, any question, clarification, concern? I hope I've not lost you guys.
Okay, this is Catherine. I just wanted to bring or rather introduce a spanner into the works.
Yes, Catherine.
Yeah, this is one of those areas that HRs have never been involved in. And anytime it is also taught, they lose they lose value for this kind of knowledge because they are not involved. And this is also one of the areas of integration. The human resource department has its balance sheet.
Yes.
It has its balance sheet. Now, because the balance sheet value from the human resource angle, and that is now the issue as to why they should share a seat with finance in the board meetings, or probably get a higher share, is because their value of the balance sheet is that they are human beings or staff that are very high value, very high value employees, and who would look more like fixed assets. Okay, kuna fixed assets za wale watu wenye they don't go for leave because they think they are part of the furniture. But these assets that you know that if this person left this organization, the organization would run a risk. Yeah. And so those people come with some certain other quiet costs that may not be seen in monetary value directly. But if HRs were to sit on a seat with finance department, they would actually know these are highly protected staff or human capital. Okay. But they are also, the general level of employees would be like current assets. You know, the current assets have a relationship with short-term issue. And so staff turnover would happen to be there. Okay, because you know that they are good ones, but they are also current liabilities. Those ones that I'm saying, they are bad employees, you'd want them to leave, but probably they are politically connected to State House. You know, so because of that, you cannot remove them. But they are liabilities and you know that. But for HR, they need to have this kind of knowledge for them to translate the information you are giving, which is data-driven, to the soft nature of their work. Now, when you look at liabilities, and by the way, I've done CPA, so I'm talking from a level where I understand. The aspect, no one calls the head of HR to bring the value of leave. To translate the HR staff handbook into a finance component. Like when the year end ends, there is leave which is owed to staff, which if the staff leave, you have to pay them. That is a compliance issue. It's a labor issue. But they are never called. And so for me, I'm a person who says the balance sheet is never reflective of what the company actually is. Because if you don't have the value for leave and you are in an EPZ, maybe where you have employed people, the value of leave is very huge there. So there is also the aspect of the liability of the capital, the equity owner who makes bad decisions. So that's a risk value for the business because they are annoying the good asset employees. The asset employees, those ones are leaving. How do you put that into quantifiable aspect so that the owners of the business can listen to the HRs? This is one area that if a HR actually can encounter the shareholders directly and tell them, you cannot touch this person because of 1, 2, 3. That is not there. And so that is the reason why entrepreneurship-driven SMEs die because of that kind of thing, because HRs are never connected. And then there is also the other issue of prepayment. Payments, which are values that accountants need in order to have a proper balance sheet. You have things like insurance, medical covers, or WIBA, workers' injury and benefit. Yeah, because it covers positions. So when the year has come to an end, that position averagely has been paid in advance because it's an insurance. So it goes with the life of an insurance. Do you normally even ask for what's the value for this? Because WIBA has a quotient which is related to the salary. So HRs are never asked. And this is where where organizations look very liquid, they look okay. Then overnight, they are going under liquidation. Then you start wondering why, because you never involve the HRs in this particular aspect. Another area for integration is the subcontractual value, like independent contractors. You are saying we have very high costs in staff turnover. You can have a conversion factor and say that the contractors, the independent contractors, because they are not exactly gelled to they are gelled to the job. If the job is done, including consultants, what kind of value is that in terms of turnover, in terms of the P&L, income and expenditure? What value are they bringing in? The only people who can answer these questions are HRs. It's never finance people. Because if I know that the mama mboga who brings, because I'm in a restaurant and so they are very key, the value that they bring in, is the only person who can answer that is a HR person. So these answers or these questions are left to accountants who sit in offices. They have no value in terms of asking, but if that area was integrated, probably the accountants need to start asking the HR department to bring their own balance sheet value, to bring their own cash flow. You see, so that you can see how to convince the owners. Maybe that's how I'll interject for now.
Thank you so much, Catherine, for your insights. And it's interesting to to hear, especially with your background in finance and you practicing HR. I'm assuming you practice HR. You are able to bring out that integration, and this is what we've been talking about since we started the session. There is a lot of sitting down together. If I can quote Catherine, there's a lot of sitting down together that is required so as to be able to even add more value to the firm. It's clear, or it's coming out evidently, that probably the finance the finance aspect may be missing out on on the HR perspective when preparing some of these statements, preparing the budgets, coming up with the financial policies. Probably we need more than one HR person in some of those committees for representation and for insights. Yeah, and the fact that it's even more necessary to have the HR perspective only underlines the importance of the staff in the whole corporate management. The staff are coming out as one of the as they are rising further on the pecking order. As much as we have the money, we also need the staff. We need the staff. We need the staff representation in the policies. We need the staff representation in budgeting. We need staff representation in policy making, and that is that is well done by the HR professionals, and that is you guys. So we can see, even as I prepare my balance sheet in the finance room, Catherine and the rest of you also have your own staff balance sheets. That's a very interesting perspective, where you even have current, you have bad staff who can be liabilities. You have bad owners who also make the liabilities even bigger and all that. Yeah? So we need more of these interaction between the finance aspect and the HR aspect and details. It continues coming out clearly. So thank you guys for that. I think maybe we can touch on the income statement. Can touch on the income statement. So this is another key statement prepared by prepared for companies. And an income statement, or basically a profit and loss statement is one of the main misunderstood statements ever. And this is because of the focus on the end value chain. Yeah, because this is the statement that will tell us the profit or the loss. It will say this is the profit we made during the year, or this is the loss we made during the year. Ikikuja profit, ikikuja positive, we just say we made this profit. This is the end goal for the business owners. This is the end goal for the shareholders. But is this the end goal for the staff? Will we be focusing on that end goal, or should we be focusing on this end goal? Should we be focusing on the profits at whatever cost? Yeah. Should the management, run over the staff, just to make sure we achieve our bottom line, the profits? You're the HR people, you're supposed to protect us as the staff. You're supposed to make sure that we are not dying just to get that figure pale chini as a positive, just to make more money for the business owner. Because that's what the business owner wants. They want value for their money. They want value for the investments. And the HR, I'm sure, wants value here to the staff. So again, the issue of balance, even as we seek to profitability. We want profitability for the farm so that we keep our jobs. We want profitability so that we grow and we are able to even employ more people. But at what cost? At what cost? Will you make me work, 12 hours a day so that the company makes profits? Will you make me come to work on Saturdays and Sundays with no extra motivation, no extra pay, just because I need this job and because we need to make money for the owners? So the interpretation of the income statement depends on who you are. If I'm an investor and wants to invest in this company, I'll first want to see if this company is making profits or losses before we start negotiating. Yeah. If I'm the business owner, I'll just call the bosses, I'll call the CEO and want to know why we are making losses or how we can increase the profits. Yeah, so the income statement basically compares the total revenues of the farm and the expenses of the farm. Yeah, so we want to get the difference between these are the sales that we've made. This is the revenue that we've collected. Now we subtract from that, from our revenues, we subtract the associated expenses. These are all the expenses. There are so many. So I've just listed a few here. So we start with the sales, with the revenues. It can be sales if you're doing sales, can be any revenue collection. If you're KRA, these are just the collection from the tax collection. If you're a service provider, these are the revenue from the services that you're giving. If you sell products, this is the sales revenue. It will change depending on the type of farm. So we get the total revenue for the company. And then now we start deducting the expenses that we incurred. These are the expenses that we incurred when making the revenue. Okay. The expenses that we incurred when making the revenue. The first one is, if you're selling products, the first expense, of course, is the cost of those goods. Yeah. If you manufacture a pen and sell it for 20 shillings, you will have, of course, there's the cost you incurred in making this pen. It's probably maybe 5 shillings or 10 shillings. That is the cost of the goods that you're selling. Of course, there is the salaries and wages that you used to manufacture the pen. This includes the permanent staff, the casual staff, and under these are, of course, these are broad category. Inside hapo kuna all those other staff related expenses, including the allowances, including the medical costs, including the bonuses that you give, including even the pension, including all that. Anything that is staff related will be lumped together. We have things like the rent expense. If you pay rent for, wherever you're working from, the utilities, these are the bills, electricity, water, all that. Advertising for your products, something we call depreciation, that is the loss of value of the assets that you used to do the manufacturing. Interest expense that you incurred. So the expenses are so many, and will always be dependent on your institution. So maybe you can come up with, or you can start thinking of the expenses that you incur based on where you work or what you do. So from the total revenue, pale juu, we deduct the total expenses to come up with what you call the earnings that you made, or the gross. You can call it the gross profit. Because we are calling it gross, because you'll have to pay tax for it. So you pay tax, or we also call it earnings before tax, EBT. So the earnings before tax is that gross income for the institution. So of course, after you pay tax, we now have what we will call the net income, or the profit, or the net loss, or the loss. So these are basic example, or a sample income statement. So again, I can invite any comment or clarification on the income statement. Anyone?
Yes, I could interject. Maybe it's probably only me who is the devil's advocate here.
No problem. Go ahead.
But this is also one area of integration, in the simple fact that when you look at KRA right now,
yes,
and how it's functioning, and the tax brackets that are coming up, there are expenditures that accountants can help HR to know how to make economical sense, especially reduction of taxes on employees. Like, for instance, if reimbursements are actually not taxed,
yes,
how to cleverly, sometimes cleverly can translate to any other issues and whatever, that now the accountants would say, that for this particular aspect, we will include this money as a cash deposit. For instance, there is a cash value, say I give the HR 50,000 shillings, basically to take care of their airtime and to take care of their fuel and stuff like that. So I keep it as cash deposits, in which case you'll account for it as a balance sheet item. But in expenditure, instead of this person being given that as a taxable item, you make them have a reimbursable format. So the reimbursable format means it's not taxed. And so the staff are educated to always bring receipts, or to always speak receipts, those kind of training grounds for finance and the HR to work together, so that the high level employees don't keep writing letters for the HR to consider them for a pay rise, just for the pay rise to work for taxation. Because you can have really an employee who is extremely depressed, and he tells you he never told you that he was working for himself and the government, because it's him who wakes up in the morning and comes to the office. He has never seen the government there. So why are you paying the government on their behalf? There are some employees like that. So how can we help bring up the expenses to reimbursable value. This is an area of training, and it is never done to top level employees, and they end up getting pay rises, but they lose the pay rises to tax just because the accountants who know this will not tell them what to do. So it's also something that I thought I could interject.
That's a very interesting point of view, actually. And I think listening to you as the business owner, I would want to pull you closer because you will be helping me pay less tax. Yeah, I don't want to shout that. You'd be helping me pay less tax. So ideally, you can see from having you closer in the boardroom, some of these suggestions coming from the HR perspective. And with the integration and the liaising with the accountants, you're able to create more value for the for the business owners and for the shareholders also. So these, again, like Catherine has rightly said, this is a key point of connection between connection for our roles. Yeah, anyone else with some contribution? I hope we have not lost some of you guys along the way. Anyone? Okay. Mombi, you want to say something?
No, I'm also learning now.
Okay, thank you. So
Mwalimu, we are together. Yes, learning a lot. Yeah, the session is enjoyable.
Thank you, Mary. So we can briefly look at something else, another financial statement known as the cash flow statements. Cash flow statements. So just a minute. You can see this?
Yes.
Okay. So this is another brief illustration of what we call the cash flow statement. So basically, a cash flow statement is just that. It's a statement that shows the flow of money in the company. So the flow of money is basically what's coming in and the money that is going out. So it is basically showing how much we are bringing in from our operations. It is showing how much we are, how much money is going out through our investments, and how much money is also coming in through financing, people bringing in money for financing. So it has three main parts. The cash flow statement has three main parts. So the first part looks at cash flow from operating activities. So operations are basically what we do on a day-to-day basis. Yeah. So we are looking at the money that is coming in or going out from our day-to-day operations. One thing to look at here is some expenses. Yeah? For example, increase in inventory. Inventory is basically stock. Yeah. So if you're in a firm that deals with sale of products, maybe you buy items and then sell the items. So the moment you purchase inventory or you purchase or you increase your stock, it means that cash has gone out. There is an outflow of cash. Okay. So an outflow of cash will occur when you increase the stock that you have in your warehouse or in your storage. What happens if we increase if our debtors increase? If our debtors increase, it means that we have we have made some transactions, but we have not received money for those transactions. Okay? Because debtors are basically people who owe us money. So it means that if our debtors increase, like we're saying here, an increase in accounts receivable. Accounts receivable is the debtors. If we increase our accounts receivables, if we increase our accounts receivable, it means that we have made sales, but we have not received money for it. That's why we are, if you see from the screen, we have the 10,000, but it's in brackets. It's like a negative because we have not received money for it. No money has come in. We have made operations, but no money has come in. Increase in inventory, we have brought in stock and money has gone out. It has not come in. That's why again have a negative. Increase in prepaid expenses. These are expenses that we have paid in advance. These are payments. So this is an outflow again. Money has gone out. Increase in accounts payable. Accounts payable are the creditors. So this means that we can see it's a positive 10,000. This means that we have maybe purchased, we have maybe brought in goods, but on credit, money has not gone out. That's why our creditors have increased. We owe them money at Ujawalipa, so it has increased. So that's how we summarize the cash flow from the operating activities. So we just get a total of that. We are just looking at our normal daily activities are purchasing stock, selling stock, incurring these expenses, paying for bills and all that. So the first section of the cash flow statements will summarize that, whether it's cash going in or cash going out. Then we'll get the net impact of that. Like in this case, we have a net impact of 70,000. So the next section is about the investing activities. So the first one was cash flow from operating activities. Next, we have the cash flow from investing activities. Investing activities are basically cash flows involving long-term asset purchase, long-term incurring a long-term loan, things. But we mainly, for investments, we mainly deal with the assets. You invest in an asset. You don't invest in a loan. So we invest in an asset. So we can purchase land. That's a long-term asset. We can start working towards a patent or purchase a patent. That's a long-term asset. We can purchase, property, buildings, machinery. So all that, the cash flow that will arise from that is what we are calling cash flow from investing activity. So the key difference between the operating activities and the investing activities is the duration of this thing that you're paying. Tumesema operating activities are the activities that you're doing on a daily basis. I'm not sure there are people here who purchase land for their company on a daily basis. But this week you purchased a building, next week you're planning to purchase another one, next week you'll purchase some land somewhere. That's an investing activity. It takes time. The operating activities, you can pay bills even every week. You can pay bills every month. you'll purchase stock every week or every 2 days, things like that. So that's the main difference between the two. And then we have cash flows from financing activities. Financing activities are activities that we undertake for us to obtain money to run the company or to run the institution. So basically, how do you finance the institution? Of course, you can finance it through loans. You can finance it through, of course, owner's capital, the injection. The owner can inject more funds into the business. Or you sell shares. The shareholders will bring in money, unawapatia shares, but they have given you money to run the institution. So some of the activities which are categorized under the financing activities include the issuance of shares, what we're calling the common stock. So now the proceeds that we'll get after we've issued shares, umepeana IPO, people have bought our shares. So what happens? They're giving us money, we're giving them a document. Yeah, and this money we'll use it to grow the business or to grow the company. So that's what we're calling the proceeds from issues of common stock. We have the long-term loans. We go to the bank, take a loan, or take a 10-year loan, a 15-year loan. The bank is financing us. We repay the loans. That's a cash outflow. Money has gone out. Yeah, we have repaid some loans. Money has gone out. We have paid dividends to the shareholders. Imefika at the end of the year, we have declared the dividends to be paid, and you have made the dividend payment. Money has gone out to the shareholders. That's a cash outflow. And we are saying we are classifying it under financing activities because these shareholders gave us financing. They have given us capital to work with. They have given us capital to run the business. So that's it. That's it with the cash flow statement. It has those three sections pamoja. We have the cash flow from the financing activities, cash flow from investing activities, which includes the investment in the long-term assets, and we have the cash flow from the operating activities, which will be always larger because this includes what we do on a day-to-day basis. All right. Anyone with a question, interjection?
I have a comment.
Yes, Mombi.
There's somewhere I read that I don't know that it applies now or it applied some times back, and if it really applies, that you can use depreciation as tax avoidance. One of the tactics for tax avoidance, and I thought at least this and maybe any other strategies that I've just thought about it, that one of the outcomes I'd like to get here is that once I understand what you're training, is that now I'm also able to read on my own. And if, let's say, our finance person is not aware of certain things, then I can mention like now what I'm saying about depreciation. Then the person can say, yes, it applied maybe in the former act, doesn't apply now, etc., etc.
Okay. So depreciation is an expense. Okay. And what we do, you make a provision for depreciation. So basically that means that you're putting some money aside to cater for the expected depreciation, for the expected loss in value of your assets. So I don't really see how you'll be able to, to achieve tax avoidance through provision for depreciation. The only thing it will help to some extent is reducing your net income. Okay, because it will increase, the provision will of course increase your expenses. So it depends. It will really depend on the size of. It will depend on the size of business. So because the provision for depreciation is usually a percentage, and it depends on the asset that you are providing for. It depends on the asset. So if you have a significant size or chunk of the assets whose depreciation you want to provide for, then you will end up reducing your income pale chini, and of course the tax on it will end up being less. But that is expected, that is allowed. So you'll actually not be tax avoiding per se. You'll just be doing the right. You'll just be following the right process. It is what is expected of you. Unajua, when you talk of
I think it's actually a good thing. I think, is it tax avoidance I think tax avoidance is what? Taking advantage of loopholes and etc.
Yes.
So I think the less tax that you can pay, okay, you make as much money as you can, but try as much as possible to legally pay the least tax. But anyway, like I said, this is something that I read. Of course, I'm not a professional in this, but then I was thinking, if I know after this course, then these are the kind of discussions that I'd like to be having even with the finance team, because then they'll probably now need to go research some more, and
Sure.
But if whatever they say is considered as the gospel truth, even them they'll become lazy. They'll really just report basic minimum.
Yeah, sure. I understand. Yeah, so we just hope that they're following they've been doing that, because if they have been doing that, then that's just the right way of accounting for depreciation in the financial statements. So maybe when you get back to them, you can confirm if they have been making that provision for depreciation. You can go ask them, how much provision have you made for depreciation in this period? I'm sure they'll be able to give a better feedback. Thank you. Catherine, yeah, I see your hand is up. Kindly.
Yes, I just wanted to also consider this cash flow statement is probably one of the most useful statements to HR, because it is normally the complicated one, the one that they don't relate to, but it's also the one that brings in. Somebody earlier had asked the question, or had said they were hoping after this course, the first casualties are never staff. When we are talking in terms of reducing expenses, and they start looking for this, that staff reduction costs is normally what is traditionally perceived to be a solution, which may not be a solution. But now looking at cash flow, I thought that, you see, we are looking for this boardroom to be opened to HR professionals. And what would the cash flow statement look like if a HR professional walked in and talked about that operating activity income has a direct relationship with them having hired the best employees? You see, the value of best hiring decisions, because then you would see the value of the HR office, because probably hiring them participated in the increased revenue. So HRs normally have done this. They have done their best. They have hired the best, and that best person has, he has or she has contributed to the revenue going up, but they are not named. Then the issue of increase of debtors. Yeah, it looks as if because it's a current asset, it looks as if it is a very positive thing. But you could have increased debtors because people can't pay. I mean, stuff happened and companies closed down during COVID. So this person exists in the balance sheet, but they actually are valueless because maybe the company closed down. You are not able to coop this money, so that they also understand that the debtors that need to be there need to have more of a current value. And so if you have bad debts provision, that bad debt provision has a relationship with the HR department. This becomes one of the cautions of marketing department or sales department being evaluated of the debtors. How can you attach them to the sales staff so that there is an issue where performance can also be tied to that increase of debtors? Because at one particular point, we had an increase of debtors and we were looking like we have a cash flow statement that looks very good, just to discover that half of them who are in Eastlands were shops that you can't even get. If you decide to go at you are sending now the debt collector, they don't even know Mama Njeri ni wapi. Alafu Mama Njeri kumbe ni mtu wa cash. Hata alipangi na invoice, hata ajui invoice ni nini. Yeye anaitishanga vitu zinaletwa analipa cash on the spot. So the salesmen have their own internal trade. So the issue of debtors of operations has got a lot to do with the involvement of HR because it helps them in staff evaluation. Then there is the aspect of equipment, decisions on equipment. Equipment, do we buy equipment that has a technological issue that it's changing? Wewe unabaki sasa kwa kampuni ulinunua like a harvest of Motorola's. And so you look like you have a very nice looking balance sheet, but people can't use these Motorola's. They start looking like radio over-overs that are not usable. Alafu sasa accountant tu anaziwekanga tu hapo. And then now there is also the issue of market value versus book value. You see, because accountants retain, maybe that's an accounting base. Accountants retain things at the price they bought. But if you are selling the company and if you are looking at the value of the company, why don't you get a valuer to value things so that they look like a market value? In one of the institutions that I worked, which happened to have been in Upper Hill, we had to tell them, you need to get a valuer here because the land in Upper Hill is the most expensive place and the per acre. So why would you hold values at these book values? And immediately the value went up by 1 billion. It was a major issue that actually changed, including the institutions or the government values that have to come in. Then they actually realized that the business is viable because the business was going to be closed down, but it had an asset that was very high value. So there is that issue of market value versus book value component that HRs need to be involved in because of purchase of some of this equipment and also getting rid of very old stuff that looks like government offices, but you are not able to sell them. But they seem to have a book value, but they can't be sold. And then for investment activities, HRs have a component which they call COLA, the cost of living adjustments. Now, cost of living adjustment is an issue that is debatable right now because January sugar 2 kilos was, like 215. Now that's the price of 1 kilo. And so what happens to the employees who are still being paid the same salary? You see, how does the HR come through investment activities to come and sit in the board and say, we have a component here which is long-term and which is called cost of living adjustment. How are we able to cushion these good employees who are bringing in, revenue or helping to bring in high revenue? How do we cushion them against the cost of living? So that's an area that I have seen that you need to do. Financing activities, headhunts. are a financing activity. They are HR oriented, but a headhunt when they are planning is part of increasing the brand, reaching or making the brand work out there. Another financing activity that HR is never involved in, and it is actually the one that needs to make the decision, is research and development. R&D is an aspect of HR. And this is the part that millennials work very well, because they are the ones who are heavily invested in artificial intelligence. And people are missing the point. They are not utilizing them, but they come fitted, fitted from wherever they come with the aspect of artificial intelligence, which is being overlooked by organizations. But the only people who can bring it to the table is HR. Financing activities, the bank interests have moved consecutively almost 5 times. Yeah, 5 times that, your loan by 16th will be at 9.5%. Kabla ujaketi isha ingia 9.75. Whatever. And now you can't do anything because the loan exists in the bank, and there is an open use of diaspora financing activities. We call it the Come Back Home program. If diasporans can be talked to and to be involved by HR, see accountants hawana hiyo language, because they are normally statistical and mathematic driven in terms of how they operate. The HR department is the only department that can sit and bring such programs so that they help now the financing. Sasa hatuendi kwa bank, tunasema kuna watu wenye wanaweza, we can bring them, we can have a partnership deed with the diaspora community to help us with money, because maybe their money is not as expensive. I helped bring a component like that, and they heavily brought 75% of the money to actually bring up something that was under research, because they want to come back home and come back home relevantly to organizations that they can belong to. So do we have programs like that where we can partner with the diasporan community? And I think these are some of the healthy debates that ACHRP can bring on board, which can help people from a learning, an academic component, to a debate level that empowers HR professionals. Thank you.
Thank you so much, Catherine. You're actually giving us very useful insights and approaches, HR-based approaches to, to very critical financial bits. You're talking of research, resource mobilization from a HR point of view. Normally, when you're talking of the company is looking for resources, you're looking for donors, you're looking for financing. I don't think they have HR inputs in mind. And it's evident that you guys have a very different and unique perspective, which is even much cheaper, much friendlier, and much beneficial to the company. So I hope for everyone here, I hope we are getting to see how much more input we have into the towards the financial health of where we work, apart from just the HR, from working from the HR perspective. We have so much more contribution that we can make towards the financial bits of these, and Catherine is clearly leading us in this. Yeah, thank you so much. Anyone else with something you'd want to chip in before we move to the last statement, changes in owner's capital? Okay. Can we see this?
Yes.
Oh, thank you. So the statement of changes in equity. So this basically shows the movement of the ownership funds within the company. And so basically, this is about the sale of shares. This is about any injection by the business owners into the firm. This is about payment of dividends. This is about, withdrawals by the owners of the firm. That is what it just revolves about. So it's a very small statement, and of course, it will always depend on the type of funding that the company operates with. If the company you are in is of course funded by the shareholders, that's basically a public utility, then you'll be just more interested in the issues of new shares. There's what they split shares. At the end of the year, you'll have to pay dividends to the shareholders. If it's a private firm, then you'll be interested with any injections by the owners. The owners may want to bring in more financing, maybe to expand the business. Some owners, after some time, will want to withdraw some funding. They would want to sell part of the company to some other owner. So there'll be some changes. Yeah? So those changes are what we are calling the changes in equity. So this is basically a statement of changes in equity or changes in ownership of the company. Yeah, so I'll just brush through these. There's the issues of the first bit talks of the common stock. That's the shares. We had the share values at the start of the year. You can list the shares that were sold during the year and see the balance at the end of the year, or at the end of the accounting period. Then there'll be issues of retained earnings. So this is basically what you retained from the profits that you made from the previous year. Any other income that you made, the net income that you made during that year. Any dividends that you paid out. That's why we say that's a negative, because it reduces the income, because you pay dividends on the income that you made. You pay dividends on the profits that you made. Yeah, and then compare that with the opening balance and the closing balance. So this example just deals with the sale of shares, issuance of dividends. Sale of shares, issuance of dividends. If you are using private equity, in case of any injections into the business, in case of any withdrawals during the year, where the owner came and said, now I need $1 billion from this business, akatoa, because it's his business. Maybe he wants to invest more into the business, says this year, naongeza $2 billion into it. No, that's what we will capture in the statement of changes in equity. It's usually a small statement, because we don't have a lot of movement. So it's mainly about shares sold, dividends paid, and all that. So in case there is a comment or a clarification, or I know I've rushed through this one, but I did not think there is much. I can take a question, if any, or a comment. Okay. I hope that means we are so much together. All right. So allow me to move on. back to our presentation. We've gone through the balance sheet. We have seen the samples. We have seen the income statement, which shows we saw all these. Maybe I can touch on what's OPEX. No, I'll define OPEX and CAPEX hapa mbele kidogo, and depreciation. We have seen the sample income statements. We have gone through the cash flow statements. We've seen the 3 sections that it has. That is the cash flow from operations, cash flow from investments, cash flow from the financing activities. And we have seen the sample. We have seen the statement of the changes in equity, which basically shows the changes in the owner's equity during the period. So basically includes issues of dividends, purchase of new shares, sale of new shares, and the gains and losses from these changes. Now, there's something I wanted to touch briefly hapa, inaitwa financial ratios. And there's something known as the debt to equity ratio, or the leverage. So debt to equity ratio is basically the ratio between the debt that the company is using against the equity of the company. So debt is basically the financing from other sources apart from the owners. So basically this is when you go get a loan, a bank loan, and use it to finance your activities. Equity funding is when you use funds from the either the shareholders or either the owner of the business. So debt equity ratio is a very important ratio, especially in valuation of businesses, because this ratio basically shows how stable a business is. So we basically want to see a business that is using more of its money, as opposed to a business that is using more of borrowed money. I'm not sure if that's coming out clearly. So what we are saying is we desire a small ratio. A small ratio means our numerator in this case is the debt, and our equity is the denominator. So for us to obtain a small ratio, this means that we want to have more equity, to use more equity to finance our businesses, as opposed to using more debts. Tunataka, if we have 100% of our financing, if possible, let's have all of it coming from equity. But since that is not possible, of course, we will have the aspect of debt. I think almost all institutions, our good country included, uses debt to finance its investment activities. So we desire a small ratio in accounting. We want to have a small ratio, a small debt to equity ratio. We want to use less debt and use more equity. So more equity means that we have created more value for the shareholders. More equity means that more people are interested in buying our shares, and that's the money that we will use. And why are they interested in buying our shares? Because ours is a profitable institution, because ours is a valuable institution. So every investor will be interested in pumping funds into the institution. But on the other end, if you're running an institution that is not attractive to investors, that is not attractive to the shareholders, or even the owner is not even interested in it, you'll find that you are borrowing to sustain to finance your operations. You'll be borrowing to even pay salaries, you'll be borrowing to pay for any investments, you'll be borrowing to pay for bills. and your debt equity ratio itakuwa kubwa sana, because the numerator, which is the debt, itakuwa kubwa. Okay, I hope that makes some sense. So the other ratio is what we call the quick ratio, or the acid test ratio. So this ratio basically means how fast are we able to, to liquidate our assets. Yeah, how easily can we meet our short-term financial needs? If the company is in a mess and there is some money required, how fast can this company use its assets to make, to be able to bail itself out? Yeah, so this quick ratio, the acid test ratio, basically compares the current assets against the current liabilities. So it's just a ratio between the current assets and the current liabilities. And remember, we said the current assets are the assets that we can easily liquidate, while the current liabilities are the liabilities that we are required to meet in the short term. We are supposed to pay for these liabilities in the near future. So how do we pay for these liabilities in the near future? Using our current assets, using the cash we have, using collecting from our debtors, using those are using our current assets. We should be able to meet our current liabilities, and ideally the ratio should be 1. We should be able to meet all our current liabilities using our current assets. Is that okay?
Yes.
Okay, so allow me to move on to another ratio, and it was the dividend payout ratio. So this is usually computed at the end of the year. Yeah. So as you hold those AGMs and plan to issue, dividends to the shareholders, the dividend payout ratio is just a ratio between how much do you want to pay as the dividends out of the net income that you have made. Yeah. How much of your total net income do you want to pay out as the dividends? That's the dividend payout ratio. It is just the share of the net income that a company pays out as the dividends. So when a company says that they are paying out dividends of 5 shillings, they have used these ratios to arrive at that. They have fanya hesabu zao, wameona this is the amount of money that they can spare to pay to their shareholders. So that ratio is also very important to investors, because we'll be interested to see if a company that that has a high dividend payout ratio means that you'll be able to ask yourself, why are they paying so much in terms of dividends? Basically, that means that they made a lot of net income, because you can only pay from what you've made. Yeah. So these are some of the ratios that that advise on some of the financial decisions that are made when a company is declaring these dividends. These are some of the ratios that the accountants have done in the back room to come up with some of these figures to float to during the AGMs to the shareholders and to the owners of the companies. Yeah, so I can move on unless there's an issue. So I wanted to briefly. Yes.
Sorry, I have a question.
Yes.
For companies that pay for, especially like financial institutions like banks that pay bonuses
Yes.
At what point do they pay bonuses? Because it should also be at the end of the year, and it is based on the profits as well as
Yeah. So most of those bonuses, I think you should actually be telling me more, being the HR people. I think most of those bonuses are pegged to staff contracts more than being pegged on the company policies, especially for the executives, for the salespeople. I think they are more pegged on the staff contracts, but I might be wrong. Yeah?
No, you're right. But I'm not talking about that level of stuff, like really very senior stuff. Like, for example, in the US, what happened in 2008, you're seeing, let's say, the top level, like the CEOs and other directors getting bonuses. And now looking back to it, I was wondering, since the companies were getting bailouts from the company, at what point or what justified, what reason, or how did they come up with this thing of paying bonuses when the company is doing badly? And I'm not talking about staff, I'm talking about those really high level people.
The senior executives.
Yes.
Yeah. So I think there are two scenarios. There could be two scenarios here. One, they could have allocated themselves the bonuses to their contracts. They could be attached to their contracts. Some of these guys are the decision makers. So some of them customize their contracts. Some do not even pay themselves salaries. They want to pay themselves a share of the profits that the firm makes. Secondly, it could just be a case of misappropriation, in my view, because ideally you're supposed to only get these bonuses, especially for the top executive. They're supposed to get the bonuses pegged based on the profitability of the company. So it is not expected that a company is going down, you're declaring losses, but the executives are making millions in bonuses. So in my opinion, it could be a case of those two. Maybe they have pegged their bonuses on their contracts, whether or not the company makes losses or not, or profits, or they could just be rogue executives, just wanting to get out money from the institution, even when the institution is doing badly, in my view. But ideally, I think it should be a share. The bonuses should be a share of the profits, just like the dividends, in my view.
Yes, I think you're right. I don't think number one is right, even if it is in your contract.
Yes.
Even if it can be in the contract, it's actually a percentage of an income. So
yes.
if you're negative, still the percentage will be should be zero, because now you're not expected to pay you're not expected to pay the company because the company is doing badly. So worst case scenario should be zero. So I think number two, where they are not straight, I think that is the most appropriate answer in my case as well, and not
Sure.
number one.
Okay. Yeah, thank you. So we can brush through some of key terms. These are some of the key terms that go almost hand in hand, but could be a little bit maybe conflicting for someone who is not so conversant with it. One is the issue of OPEX and CAPEX. OPEX is basically the operational expenditure. These are costs that are incurred in the regular course of business operations. I think we've mentioned some of these. And we are saying that they include, the first one, of course, is the salaries and wages of employees. We have things like the utility bills, the rent, the office supplies, all those repairs, marketing costs, advertising expenses, premiums paid for insurance, travel expenses, and all that. So all those form the operational expenditure of a company. So OPEX and CAPEX are basically they all talk of the expenses that a company incurs during their operation, but we differentiate them because operational expenses, just from the word, these will arise from our day-to-day operations. They are the expenses that arise from our day-to-day operations. Whereas, okay, so you're saying in finance or in accounting, these expenses are deductible before tax. So after you've made all your revenue, we have to subtract the expenses that you incur when trying to raise or to generate that revenue. That's why you're saying they are deductible before tax is charged. So before you attach, you compute the tax, kwanza unatoa all the expenses that you incurred. All the expenses that you incurred. If you have your small business Apple, you've made sales of 1 million shillings, unatoa all the expenses that you incurred, all those admin expenses, your assistant hapo mwenye anafanya kazi, stima umelipia, hizo licenses, government, all that. Unazideduct, and then what is left, that is what's supposed to be taxed. Those are expenses. And you're saying that OPEX is an expense which reduces the overall income. Yeah, by definition it is. So on the other hand, we have the CAPEX. So CAPEX is basically expenditure on long-term assets, expenditure on infrastructure. And CAPEX, these are expenses that are incurred and are expected to benefit the company in the long term. It's expected that these the benefits that of CAPEX will be determined or will be enjoyed in the long term, as opposed to the OPEX. OPEX is expected that if I incur these expenses now, maybe before or at the end of the year, we'll see the income from it. But for CAPEX, if I invest in these infrastructure projects, maybe in the next 20 years, this company will benefit, or this country will benefit. So some of these include purchase of land, property, buildings, acquiring motor vehicles, acquiring some software or technology, research and development costs. All these are long-term. And you're saying that, they appear in the balance sheet as assets. We saw these PPEs in the balance sheet as the long-term assets. But now the costs associated to these long-term assets is what we call depreciation, the loss in value. This loss in value will be captured in the income statement as an expense. Remember, we have said the OPEX zote expenses in the income statement and will reduce our income, our total income. But the depreciation is what we will take to the income statement. We will take its depreciation as an expense. That change in value. If I bought a motor vehicle in January, valued at 5 million, alafu in December, I get a value, and then they value it at maybe 4.5. There is depreciation that has occurred, and that depreciation becomes an expense, and I will capture that in the income statement. So you can look at depreciation versus amortization. So these two talks of loss of value of assets. But now the only difference is depreciation. Depreciation captures loss of value of tangible assets. These are things like the buildings, the vehicles we've talked about. This is loss in value associated to wear and tear, aging, or obsolescence. Like Catherine told us of the Motorola's. You could have Motorola's which are now obsolete. You could have software, no, not software. You could have desktops which are now obsolete and you need to upgrade. That loss of value is what we call depreciation, because it is associated with the tangible assets. So on the other hand, we have assets which are intangible, things like copyrights, trademarks, patents. These are assets, and the loss of value of these assets is what we call amortization. So the general difference is depreciation is associated with the tangible assets, while amortization is what we talk about for the intangible assets. Quickly, something else, profit versus cash. Profit versus cash. I think we could be able to differentiate these two, but profit is basically the difference between the revenue that you've made against the expenses that you incurred trying to make that revenue. That is what we call profits. Whereas cash is basically the physical money that you have. The cash you have in hand, or the money that you have in your account. That is the money that is available for your use. And we say that cash is an asset that we have in the balance sheet. It's a current asset, actually the most liquid or the most current asset there is. Profits, we have defined profits. It's the financial gain for the business. Okay. And a point to note is that a business can be profitable but have cash flow challenges. And this will happen when the inflows and the outflows are not synchronized. We are saying that a business can be very profitable, you are declaring profits, but we have cash flow challenges. And this is because, if you make sales, you capture them that you've made sales. And that translates to your revenue. It will always translate to your revenue, even if you have not received the cash for it. Okay? So you will be very profitable. When you're preparing your books, pale chini, the profits are very huge. But probably you have not received the money for the transactions that you've made. Maybe you've not received your debtors have not paid you. But remember, we said that debtors are assets. So we've also captured them in the balance sheet as assets. So I think you'd agree with me that a business can be very profitable, a company can be very profitable, but they do not have cash. They have cash flow challenges.
And where do you put bad debtors?
Pardon?
Where will you put bad? Are they called bad debt? Yes, debtors. So for a long time, we put debtors as as what, as an asset. Yes, but at what point now, when you decide to write off and let's say probably take them to liabilities because now they're not paying?
Yeah. So what we do, there's what we call again a provision for bad debts. So what you do, based on your policies at work, you make a provision for bad debts. Maybe for the debts that have exceeded a certain level, you can conclude and say that these debts are not recoverable. You write them off. If you write them off, they're off your books. But again, in the year, you make a provision for the bad debts. Now, a provision for the bad debts is an expense. Just like we have said, the provision for depreciation is an expense which will be captured in the income statement. So we also do the same with the bad debts. We make a provision for bad debts, and that becomes an expense to the company. So we take that to the income statement, and it will reduce our revenues. So we treat it as an expense. Okay.
Okay, and to take you back, CapEx, is it,
Yes.
because I think you've said with OPEX, it is what? It is, I think it is tax deductible or not taxed. So what about CapEx, since it's long-term assets, is it tax deductible?
No, CapEx is investment in long-term assets. So what do you do with CapEx? We acquire a long-term asset. Okay. So of course we'll have it in the cash flows, but now what happens in terms of tax, this comes in under the income statement. And we are saying, because these are assets that we have acquired, OPEX is an expenditure. It's an expense on its own. But in CapEx, we have acquired an asset. So the only way that we will be able to capture it in the income statement is capturing the loss in value of this asset.
Okay.
Yeah, so the
Yes.
loss in value is what will be an expense, and that is what will reduce our income. Okay?
Yes, thank you.
Yeah. So I think, my good HR professionals, I think we have come to an end of this presentation. I want to thank you all for the concentration, for persevering with me throughout this thing. But more importantly, I want to thank you for the insights. I have actually learned a lot. I've got a lot of insights from the HR perspective, and I hope we have tried to meet your expectations from what we discussed at the start. And I hope that going forward, there will be more integration. Even when you go back to your workplaces on Monday, there will be more integration with the finance people, yeah? Because we have seen and we have concluded that there is a lot we can do together. There is a lot when we bring in the two perspectives together. So I want to thank you all for attending the class, and I think I'll hand it over back to SCHRP. So thank you so much. Thank you so much. And have a good day.
Thank you.
Okay, thank you, Patrick. Thank you, our participants, for your participation today. I make very special thanks to Mumbi, Catherine Gabi for bringing out several insights that have helped bring out the content or the context of finance for HR professionals. Actually, by the end of the day, or rather one time soon, I'll share with you where this one is going. Because this particular course, HR for, or rather finance for HR, is a module in the Certified Human Resource Business Partner. By the end of the day, we are trying to bring an online content for the certification courses. That is why we've not gone ahead and maybe tried to make this particular topic. We've not added other words. The module, one of the modules in the Certified Human Resource Business Partner is finance for HR. This was the content, and we wanted to bring out that. So thank you, the participants, for this particular course. You've gotten yourself one CPD point. When you log into your portal, you'll be able to find this particular course under my courses. Then you'll be able to you can view the presentation. You can also be able to download your certificate by 4 p.m. You'll also be able to view the recording for this particular course. And one item I would really want to bring out is that next time you log into our portal is achrp.org. Try as much as you can not to create not to use a different email. When you enroll for our courses using a different email from what you used previously, it creates another account. When you lose track of your CPD points, you also lose track of your the other courses you've attended with us. It is easier to keep on using the same email. That way, you'll be able to view the courses you took in 2018, 2019, 2020, and so on. Thank you for making it possible to continue bringing you courses that are insightful. And yeah, as we try to mold all of us into competent human resource business partners. That's why we brought in a finance person to tell us what they see in us. And we also see the other side of the workplace as viewed by the finance person. Thank you. Enjoy your morning. Good day, everyone. Thank you.
Thank you.
Asante.
Thank you, everybody.